Welcome to Part 2 of the Central Banks, the Fed, and Monetary Policy lesson. In Part 1, we reviewed central banks and monetary policy, while in this section we will go into greater detail on monetary policy and discuss the federal funds rate as well as FOMC meetings. So the federal funds rate, or Fed funds rate for short, is one of the most influential rates in the US given its effect on economic conditions. When you hear the media referring to, for instance, a low rate environment, or saying the Fed is increasing or decreasing rates, the Fed funds rate is what is typically being referred to. So whenever you hear someone referring to interest rates, it is most likely they are referring to the Fed funds rate. So the higher the Fed funds rate, the more expensive it is to borrow money, and vice versa. The Fed funds rate serves as a benchmark rate that determines other interest rate levels in the US, for example, mortgage rates, credit card rates, or interest rates on loans, etc. So that serving as a quick bit of context, let's go ahead and talk about FOMC meetings. So the Federal Open Market Committee, or FOMC for short, is the branch of the Federal Reserve Board that oversees the direction of monetary policy. The FOMC typically meets 8 times a year. During the meetings, the FOMC will decide whether to change or maintain the discount rate, increase or decrease the money supply, or decide whether to maintain, lower, or raise the target for the federal funds rate. Now, the reason I am saying the Fed sets a target rate rather than the actual rate level is because the federal funds rate is actually set by market forces. The Fed has its monetary policy tools to best influence the rate, but in reality, there are many other factors that may influence where the rate level actually ends up. The Fed funds rate is not something that the Fed can come out and say, hey, we are going to set the rate at 1.5%, but rather what they can do is set 1.5% as a target, and their goal will be to use monetary policy tools to make sure that the rate guides towards the target rate. Now, as I previously mentioned, the Fed funds rate is one of the most influential rates in the US given its effect on economic conditions, and is the rate that the media typically refers to. The Fed funds rate has a direct effect on economic growth. If the Fed wants to increase economic growth, it will use monetary policy tools to reduce the target Fed funds rate, while if it wants to slow down the economy, it will use monetary policy tools to increase the target Fed funds rate. The reason lower rates lead to economic growth is because it becomes cheaper to borrow money. For example, let's say you want to open a restaurant. You will have more incentive to do so if you are able to borrow money from a bank if interest rates are lower because it is cheaper to do so. On a much larger scale, a large corporation such as Apple will capitalize on low interest rates and may engage in some sort of corporate action. The opposite is true for higher rates. One will be less encouraged to borrow money when interest rates are higher, and on a grander scale, if it is more expensive to borrow money for everyone, then the overall economy will slow down. So let's go ahead and talk about how the Fed can influence the direction of the Fed funds rate. The Fed will do its best to influence the Fed funds rate using monetary policy tools, but in reality, there are many other factors that influence rates. Let's discuss the most common tool the Fed will use to influence the direction of rates. So if the FOMC has increased the target rate, the Fed will sell government securities, and if the FOMC has decreased the target rate, the Fed will buy government securities. The underlying effect is buying securities will inject additional money into the system, thereby increasing the supply of reserves. When banks have greater supply of reserves, they are less likely to hit the reserve requirements threshold meaning they will be less likely to borrow money overnight in the reserves market, thereby resulting in a decrease in the federal funds rate. The opposite stands true, where if the Fed sells government securities, banks' reserves decrease, leading to a greater likelihood that banks will participate in overnight borrowing, thereby leading to an increase in the federal funds rate. One of the reasons the FOMC engages in setting a targeted Fed funds rate is to prevent economic extremes. Extreme economic growth can cause problems, and growth that is too slow can as well. The Fed will engage in practices to best keep growth at even levels. So one thing I wanted to show you guys was the website of the U.S. Federal Reserve. So I'm just going to go to this link here. Feel free to check it out on your own. But yeah, this is the website of the U.S. Fed, which features press releases, minutes, and upcoming meetings, and so forth. And so what I'm going to go ahead and do is click on this top link right here. So this was from September 21st, 2016. This is a pretty recent statement from when I was recording this video, released by the FOMC. So let's go ahead quickly and just kind of, look through some of the information that is in here. So you have the time of the release and the date, and then you kind of get some information on the economy. You see here that the Fed states that the labor market has continued to strengthen and growth of economic activity has picked up, in the first half of this year, etc. The committee, these are kind of the goals. The committee seeks to foster maximum employment and price stability. And then going down, the committee decided to maintain, so this is their decision, they're maintaining the target range for the Fed funds rate, as we discussed, and they're maintaining that at 1/4 to or 0.25 to 0.5%, and then they will determine whether at some point in the future there will be a need to increase rates. And then here they kind of state their goals for inflation targets, 2% inflation. And then here you can see the voting members of the FOMC policy action, and there's the current chairwoman, Janet Yellen. So let's go back to our slide quickly, and definitely feel free to go ahead and check out that link. There's a lot of really insightful and helpful things that are offered on the Fed's website. In conclusion, now that you know the impact of FOMC meetings on interest rates, I'm sure you can see the relevance to the Forex markets. FOMC meetings are highly anticipated and well followed by Forex traders. So to summarize, ultimately it is current interest rate levels and their direction that are key. In general, as the supply of money and borrowing is tightened, the demand for dollars will increase. The opposite is also true, where loosening monetary policy will lead to a large supply of dollars, which can cause a currency to depreciate. So that was part 2 of this lesson, and then look out for the next lesson, which will be a continuation of this subject matter on interest rates and the carry trade. So thanks again for tuning in.